So Janet Yellen is about to get nominated, or she's been nominated for the Fed chair, and Rand Paul is pledged to filibuster her nomination and contest it. And basically, Janet Yellen is another Ben Bernanke, another Alan Greenspan, a Keynesian monetarist that just believes in pumping money into the system, bailing out the big banks to the tune of $85 billion a month. And basically, nothing's gonna change. The only thing that's gonna change is they're gonna keep bailing out the banks even more. They're gonna increase the size of QE. Then that's basically what she believes. She's been the architect of all the QEs, QE1, QE2, Operation Twist, and QE3. Now, all this does is this is just counterfeiting. Now, if you or I counterfeited any money, we would go straight to jail. But because the U.S. has a monopoly on the manufacturing of the dollar, they can print up the dollar as much as they want to and not get in trouble. Now, we also got the fractional reserve system, which allows banks to create money out of thin air off of deposits and stuff, or also credit cards and stuff. And this is a different type of money creation, still counterfeiting, but it is legalized counterfeiting. Now, this whole system of fractional reserve banking, which basically says is you as a depositor put money into your bank account. The bank takes ownership of that money, and they can turn around and loan out that money up to 9 times what you deposited. So if you deposit $100, the bank can go ahead and loan out $900 on your $100 collateral that they use, your $100 deposit that they use as collateral, because they took ownership once you deposited it into the bank. Now, this whole system is the system basically of counterfeiting, and it's a pyramid scheme. And this pyramid scheme is destined to fail. Now, we need to basically challenge this whole system of monetary creation, this whole monetary system that we have. And basically, lately, Chase has gone. Well, what we need to do is we need to change to either a gold standard, where we put the Fed back on a gold standard, where we basically say that you can't print out more money, or what we should do is switch to cryptocurrencies, which cryptocurrencies are regulated by an algorithm, a computer algorithm, which is basically math and cryptography. It's what all the internet companies use to secure their websites so hackers and stuff don't break into it. It's the same technology, but applied to money. So this is a new form of money, and the most relevant form, or the biggest form of cryptocurrency, is Bitcoin, and behind that would be Litecoin and Feathercoin, and some of these other digital currencies. And if we had these, if we switched over to these different cryptocurrencies, and Bitcoin, because Bitcoin may not be the ultimate form. There could be some other form that comes on afterwards. But if we switch over to these, then you don't have the banks getting bailed out. You don't have monetary inflation. What is inflation? Inflation is basically the creation of new money, and that leads to rising prices. You can see that in your in the gas that you buy. Just about 10 years ago, gas was like $1 a gallon. Now it's $4 a gallon, pretty much here in California. That's a quadrupled in just 10 years. And if you look back in the 70s, gas was like 50 cents or something like that a gallon. And from the 70s to the early 2000s, there was no inflation at all well, there was still inflation, but there wasn't no major inflation in the gas prices. But after 9/11 and all the money creation done by Alan Greenspan led to inflation. And after the 2008 crisis, the housing meltdown, the credit default swaps, and all that stuff, there's been massive money creation done by the Fed. But why haven't we seen massive price increases because of all this monetary inflation? Well, the answer to that is the velocity of money and excess reserves. Well, basically what's been happening is the Fed has been creating all this money and handing it out to the banks. But the banks haven't been turning around and loaning out that money. What they've done is they've just stored it in their account at the Fed. So the Fed has pretty much, since the crisis, created about $4 trillion worth of new money. But they've got like $2.5–3 trillion of that new money sitting on their own balance sheet that the other banks, the big banks, have kept at the Federal Reserve, even though they're in their the big banks' accounts. So basically, what the big banks are doing is just holding on to this cash just in case something happens. And basically, they're not turning around and loaning out that money to the community banks like they're supposed to. Basically, the way the banking system used to work was the big banks would get a loan from the Fed, and at like at a low percentage rate, and then the big bank would turn around and loan that money to the small and medium-sized community banks, credit unions and stuff, at an interest rate. And then those small community banks would go and turn around and loan that money out to the home buyer or the small businessman, and that's how the money actually got into the economy. And now, but what's going on is we've had these big banks just hold on to the money, and because of the artificial suppression of interest rates. There's a law that basically says that the banks can only make so much amount of money off of loans. This is not credit card, mind you. Loans. Traditional loans. And the spread between that, what they could loan it out for and what they would make is so small because of the suppression of interest rates. Interest rates are at 0, and I think the law says that you can only loan out up to like 3% or something like that over what the federal interest rate is. And so the suppression of interest rates have basically cut the small and medium community banks out of the system from getting loans from the big banks and turning around and loaning out to the small businessman or the homeowner. So the only people that's been getting access to new money or to these loans are people with good credit. And you basically got to have impeccable credit, and you can only get it from the big banks. The small and medium-sized banks aren't loaning out that much money. If you get a loan from those, you got to have impeccable credit and stuff too, or you got to have a huge deposit in your bank account. So what we need to do is challenge this whole monetary system, because it's so unfair to the small businessman and even the savers. The savers are getting smashed. The old people that live off of fixed incomes from like Social Security, or they're getting like money back from their 401ks or whatever. These people are getting killed off of the inflation rate, because their savings, basically when you put money in a bank, say you get a CD or you got a savings account or whatever, you're supposed to get interest back on that, and then and your interest is tied to the actual interest rate. And so if the banks are making money off of your deposit, they're supposed to turn around and give you interest off of your on your CD or your savings account. But because interest rates are suppressed, You ain't getting shit right now. You're getting less than 1%. You should be getting like 3 to 5%, especially if you got a CD. We should be in a range between 3 to 7%. But right now you're getting probably like less. You're probably getting like 1%, and this is fucked up. When they're basically bailing out the rich. It's a undercover, incognito way to fucking bail out the rich. So we gotta challenge this whole fucking system of monetary creation. We need to basically have a debate on whether or not we should be having the Fed or not. Especially coming up on the centennial of the Federal Reserve. We need to have a major discussion about this.